Good evening, everyone. This is Nathan Hayes from IDOC and IDOC's Prima Consulting Division. Thank you so much for joining us for our webinar on cost of goods and managing your inventory. Just for those of you who don't know me, I'm the practice finance consultant for IDOC, which means I do everything from benchmarking practices and evaluating profitability and cash flow to looking at practice valuations, partnership agreements, anything to do with numbers, benchmarking, and some strategic stuff on investments. So that's me. Let me introduce my colleague who's joining me tonight, Steve Alexander. And Steve, tell our audience about your role with IDOC and Prima.
Good evening, everybody. Thank you, Nathan. I'm the optical management consultant for IDOC and Prima's consulting. They're the division of Prima Consulting, where we would consult with doctors and practice managers about just about every facet of the optical space. Pricing strategies that we're going to talk about here tonight, cost of goods that we're going to talk about here tonight, staff training and development surrounding the optical side of the business, strategizing for inventory and various other things. There's everything as it relates to the optical department in your practice. So always here, always happy to help.
And as we're getting started, just know that this webinar is being recorded. So for members who are part of IDOC Select Plus or Prima Consulting, this will be available on the Prima website and the webinar recordings that you're familiar with. And also we'll probably post it to the Prima members on Facebook page as well. So agenda for tonight, pretty straightforward. We won't take too much of your time, but I'm going to take some time talking about how do we measure and how do we evaluate cost of goods in a practice, and then hand off to my colleague to talk about from a more mechanical standpoint, what are the things we can be doing to lower cost of goods and thereby increasing profitability. Pretty straightforward. How do we understand it, and then how do we work on it? How do we improve it in our practices? And the first thing to recognize is cost of goods. Just definitionally, we'll define it as your frames, your spectacle lenses, and your contact lens purchases and accessories divided by the total collected revenue. So depending on how you track things in your own financial statements, some practices might include their alliance or buying group dues in there, for instance, like a Vision Source or IDOC membership. I'm going to benchmark it without that just because not everyone's part of those groups. So I would say that your financial statements need to work for you and tell you what you need to know. So if you want to include it, and assess where it is net of your membership dues, that's fine. But as we benchmark this, we'll just look at the actual materials and not memberships. Typically and historically, cost of goods would run somewhere in the range, and has run somewhere in the range of 27 to 33% of revenue. So we'll just put it out there right now. If you take your total collected revenues, again, that's less insurance charge-offs, so it actually hits your bank accounts. For the typical practice, cost of goods are going to be about 30% of revenues plus or minus 3%. There's some variety in that, and we're going to talk about how to evaluate it. There's reasons it's lower. There's reasons it might be higher. But understand that. And really an important point of this is to recognize that this is a ratio. There's a numerator and a denominator. So if you're evaluating your cost of goods and you feel like it's high, there are two ways to lower that percentage. You can either reduce the amount of money you spend on your cost of goods, and we'll talk about how you do that, or, and this is what we will typically end up advising, is we look on ways to raise the revenues overall. More on that, but just recognize there's two ways to work on this ratio. You can either lower your spend on materials, or you can raise your revenues overall and from different sources. So in understanding just, again, a practice's general finances look at something like this. Your top line of your profit and loss statement, you'll see your collected gross revenue. Again, that's net of insurance charge-offs, sales tax, refunds to your patients and customers. Then you'll typically have your cost of goods next, and you'll have a number called gross profit. Understanding that the whole thing, just putting this in context, we also have other expenses in the practice. We have non-RD staff. We have our occupancy costs, equipment costs, marketing, general office overhead. And then we'll come to from a benchmarking standpoint, what we'll call practice net income. That's defined as all the income and benefits available to all the doctors in the practice, whether they're employed ODs or practice owners or partners. And then before the owners get paid, we've got to pay for the associates, we've got to service debt, and then we'll come to a pre-tax cash flow number, and then we have taxes and depreciation, amortization, which are non-cash expenses that affect your taxable income. So that's why your profit and loss income might look different from what's on your income on your tax return. If we're going to look at it and really evaluate cost of goods, though, we have to recognize that there's three broad categories that your expenses fall into. And if your cost of goods look high, I'm going to ask you to look at your staff expenses. If your staff expenses feel high, I'm going to ask you to look at your cost of goods. Those typically will run together about 45 to 50% of revenues in a practice. And why do we put them together? Well, one of the shifts that many of you are participating in is that optometry has done more and more medical testing, disease management, pathology in the practice, in a private practice setting, and therefore the mix of revenues has changed. So if I'm evaluating your expenses and I see your cost of goods is only 20% of revenues or 22% of revenues, my first assumption is that you're pretty medically oriented in how you practice. My second assumption is if staff investment in typical practice might be 20% of revenues, say plus or minus 3%, I'm going to expect it to be higher in your practice. So where cost of goods falls because of structural reasons, typically the staff investment will go up. A more medical practice has more staff or more delegation and more just to support the patient flow. In a Medicaid practice, heavily Medicaid practice, cost of goods might fall to 10% of revenues, and the staff investment might push up, particularly in areas that aren't as expensive on the labor market side, might push up to 30 or 35% of revenues. So again, what you see is wherever cost of goods is, we're going to evaluate staff too, and ask the question, okay, cost of goods looks low, and maybe the staff investment is higher. We're kind of looking at it backwards that way, but either one of those numbers that you look at, I would never evaluate it in a vacuum. Usually it's going to add up to about 50%, maybe a little less, maybe a shade more. In practices where both are high, so let's say you look at your numbers and, oh my goodness, we're spending 28% of revenues on cost of goods, which on its face sounds pretty good, and 28% of revenues on staff, which sounds really high. Well, we're going to have to look at things and assess which one is actually high. Typically, one of them would be lower. Either your cost of goods is out of line or your staff is out of line. And so just bear that in mind, that it's not as simple as just saying, well, my cost of goods is 33, 34%. Oh my goodness, let's panic. Maybe your staff investment's only 16, 17% of revenues because you're a higher end optical and you do a lot of revenue per patient because you're selling very nice glasses. You don't need as much staff to support the patient flow because it doesn't take as many patients to generate your revenues. So when cost of goods are high, just to lay it out there now, there are reasons. So we talked about reasons cost of goods might be lower. There are reasons structurally that cost of goods may be higher. And typically that's going to be a very high-end optical that's carrying higher-end products. We'll get into pricing strategies, but just we'll recognize that if you're carrying $1,000 price point frames, and that's a big part of your business, or actually something that does go off your boards, your cost of goods may structurally be higher. You can't put the same markups on those products, so the gross margin isn't the same, and the cost of goods is going to look higher. Similarly, if you're a heavy contact lens practice, again, because there's not the same margin in that product, cost of goods may be higher. So again, if your cost of goods is at 34, 35%, again, it's higher than normal, but that may be just a structural feature of your practice. Typically, I'd also expect your staff investment to be a little lower. And we'll talk about what you can do. But one thing to be looking at is, can we diversify our revenue streams and do more medical testing and maybe raise our exam fees? So be looking at that as we evaluate that. Let's just talk about, as we look at profitability, let's go beyond just focusing on this expense area. And again, why do we look at this? It typically is the largest expense area for most practices. So if you want to work on your expenses, as Willie Horton said about robbing banks, that's where the money is. Your cost of goods typically is where the money is to save. And it's also, of all the expense areas you can work on, it is, if it's out of line, thankfully the easiest one to address. And if you go down that list of expenses on a P&L, as we're looking at that, staff, we can work on that, but letting people go has culture implications and just running the business implications. Occupancy costs, what are you going to do? Fire a 30-year space, your equipment's pretty locked in a small amount. marketing's pretty locked in. It's a small amount. Sometimes there's some stuff in general overhead. Maybe you're spending too much on your accountant or something. It does happen. But typically that's pretty baked in as well. And in reality, if you look at the expenses in most practices that I look at, and I've looked at probably at least 1,000, if not 2,000 P&Ls in the past several years, I typically don't see a lot of fat to be cut off the bones in practices. Again, cost of goods would be the one area that sometimes has the opportunity, but there's not a whole lot of fat there to trim. So let's think about what that means. So let's take a pretty typical $1 million practice. These are very easy to understand ratios. $1 million practice with that typical 30% cost of goods, 20% for staff, so 50% of the revenues are being spent on cost of goods and staff. We got $200,000 in fixed overhead. Again, that looks just like the ratios we were considering. And the practice net $300,000, whether it's to owner or multiple doctors. Who knows? 30% net. So this is basically your textbook example of a practice. And let's say we were able to cut 10% from the cost of goods. So we dropped it from 30% to 27% of revenues over the course of a year. So it's been a year. We're going to let the fixed overhead go up 3% just to pace with inflation. We held the line on staff costs. So had a little change in fixed overhead, $6,000. Then we cut $30,000 out of our cost of goods. And okay, the practice is ahead. $30,000 falls to the bottom line, less that change in fixed overhead. So we're ahead $24,000. And okay, that's profit to the owner, and it's a good thing to do. Now let's look at the other way. Let's say instead of working on cutting 10% out of our costs, we were to work on growing the practice 10% from a revenue standpoint. Revenue's up 10%. So we're at 1.1 million. We let the cost of goods float. It's up to 330,000. We let the staff investment float. We hired a part-timer or maybe hired someone mid-year. So we're at 220,000, still 50% of revenues. Notice that the fixed overhead is fixed. It doesn't change necessarily with the revenue. So it's the same in both scenarios. It's up 6,000 or 3%. Again, it's an inflation number. And the two things to note. One, more money fell to the bottom line. Because if you think about what it costs to see more patients in your practice, to see one more patient costs you whatever your cost of goods are. To see a bunch of more patients, again, you're going to have to add staff, as we see in this example. And again, what do those typically run? About 50% of revenue. So about half of the growth in your revenue is going to fall to the bottom line. Again, less whatever changes you have in your fixed overhead. So this is assuming you don't have to move to a new office to get these people in the door. And the practice is up about 44,000. The ratio's a little smaller. The practice net income percent's a little lower, but the dollars are higher. And I would take that change all day long, especially in a larger practice. What's the implication? If you really want to increase your profitability, you're far better off focusing on getting more patients in the door and generating more revenue per patient than you are chasing after cutting costs in your practice. It's a far better use of your time. And by the way, it's pretty ambitious to say that a practice is going to find 10% of its total cost of goods that it's going to cut. What I will tell you is that, and we'll talk about how, but the one place you're not going to find that more than likely, especially as we're all members of IDOC and getting pretty much the best discounts you can get in the industry. In some cases, absolutely the best discounts you can get beyond being a chain. There's just no play on the discount. So you're not going to find it in the discounts. Maybe there's some things process-wise you can do. But, at the end of the day, do both. Continually evaluate your cost of goods, track it, look at ways to be more effective in managing that. And we're going to talk about how you do that next. But if you can focus on growing the practice in the long run, it's going to pay many, many times over for your energy there, what you would cutting costs. And again, my experience with hundreds of practices now, thousands of P&Ls evaluated over multiple years. Typically, yes, there are instances where cost of goods are high, but normally it's not a function of discounts. So I'm going to start handing it over to Steve, but let me just say this now. If we're going to triage cost of goods being high, let's say we feel like 30% is high, or we just want to look at it and say, how could I lower my materials costs? I feel like that there's some profit to be had by lowering my expenses. Here's my triage, and pay close attention to it. The first thing I'm going to look at, if cost of goods are high, you want to work on it, is your fees and markups. In other words, we're going to look at the revenue side of the equation. The second thing I'm going to look at is our processes for ordering stuff and how we manage our inventories. Third thing is going to be discounts and again, for pretty much everyone on this webinar, this should be a non-issue. The reason you're part of IDOC, and I've evaluated, I've been in the buying group business for, and the alliance business for 10 years now. My first job in eye care was with HMI Buying Group in Red Tray, then with Prima, which had a purchasing program before we were bought by IDOC, which is primarily a group purchasing organization and alliance for networking with ODs. I know everyone's programs. I've evaluated at the beginning of this year. All the major alliances you can think of are all very comparable, including the really big one. So it's not like you're leaving money on the table if you're part of IDOC and using the programs. So with that, I'm going to hand it over to Steve, and he's going to talk about, what are the process things you can be doing in your practices to better manage your cost of goods and work on getting it lower and increase your profitability.
Thank you, Nathan. All right, so there's, like Nathan mentioned, there's a numerator and a denominator to this part of it, and the numerator is where your actual costs are, where the dollars and cents are being spent. The denominator is what you're generating. So there's a couple of different things, a couple of different approaches to grow your business, and before we get to that, I want to talk about pricing structures and some options that you have in that respect. So. One slide too quickly. This is just a quick look at MBA averages of practices with their pricing benchmarks for spectacle lenses on the left-hand side of your screen, frames on the right-hand side. What you'll notice is as your costs go up, as we're talking about higher-end product on both lens and frames, your percent margin goes down. But to Nathan's earlier point, you'll take the percent going down if the dollar margin itself is actually what's rising. So when you're talking about a frame that's over $400, you're looking at a two and a half time markup, as opposed to something that's less than $100. You're talking about a 3 times markup or a little more than that. Just make sure that you know what your actual market value is for the product that you're selling and represent it accordingly. Now, generally speaking, you're not going to be selling a ton at full retail price. You're going to be giving discounts pretty regularly, so give yourself enough cushion where you absorb that discount and still make yourself enough to operate. But as we talked about at the outset of the meeting, at the webinar, this will be available to you on the regular Prima resources page. You can see the numbers for yourself and have it readily available. Moving on to pricing strategies. So one of the things that Nathan had mentioned was that if you want to grow your business, one of the first things you want to evaluate are your fees. And we can talk about pricing with respect to your professional fees. We can talk about pricing strategies with respect to your optical product. So one of the strategies that I find to be very effective is one called anchoring. You have a look at this. It'll give you some ideas of how anchoring works in a different industry, but the suggestion is that you suggest a price at a higher price point than you anticipate your patients or customers actually purchasing. The little cognitive bias that adjusts a patient's expectations, it sets them up to purchase a better pair of glasses than they otherwise would. So the idiom there is, how do you sell a $2,000 watch? By putting it right next to a $10,000 watch. It makes it context specific, but it softens the blow a tiny bit, as it were. And this works not just in watches or optical. You see it all the time in online options for memberships or various other things, where you have your most expensive option first, and then the one that is most affordable sounding, or the one that sounds the most reasonable, gives you the closest approximation of the very best thing at a slightly lower price. This is something I'm sure all of you have seen time and time again. If we're able to incorporate that into our pricing strategies, we'll actually see that our average per patient is like so this is just something simple called anchoring. Now I'm going to show you something that most of you have probably heard of a dozen times in any conference that you go visit. Good, better, best pricing. It's something that simplifies the process for your staff. It should theoretically simplify the process for you in your handoff from the exam lane into the optical. should simplify the decision-making process for your patients as well, so you don't have to talk about a bunch of different types of progressives, a bunch of different materials, various coating choices. This simplifies the process. Now, in this case, I took away all the branding, but if you had something like this, you'd probably want the brand of lens that you recommend listed on here. This is something that I had created for a practice, and they treat it like a placemat in front of the patient where they can run through these options. The recommendation would be to have a brand-specific recommendation come from the doctor and have that feed through into the optical, so there's a little bit of recognition from the patient. Once the patient sits down, hears whichever brand you guys recommend a second time over, it's more likely to sink in and make that purchase. This menu is another example of an anchor. Here, we're looking at best as the anchor, where it has, the full suite of features, all of the options that a patient could want theoretically, and when you put it in that particular context, your patient is more likely to either get best, in this case, if we're able to demonstrate the value, or if the price is too high, they're more likely to get better. If best doesn't exist, if that's not presented to the patient, then they'll usually go with the least expensive thing presented to them. So if we start high and back off a little bit, a couple of things happen. Our staff gets better equipped to offer higher quality products, which is vitally important for every optical. Our patients become more attuned to the options available to them, and they're more likely to select a higher quality product, which in turn engenders loyalty. And that's something that we're always looking for. A patient who spends a little bit more on their glasses is more likely to return to that same practice again, because the odds are they've gotten a better pair of glasses as a result of that. So it's simple, couple of different approaches to pricing, but a way we can apply this strategy in the optical here. Moving on from that, pricing strategies. Nathan had mentioned earlier there's some operational things that we can do to affect cost of goods. Something that I find in my consulting is that inventory control is not something exercised by a lot of practices. Many of these operations are sort of haphazard and improvised by staff preference, or the way we've always done it is one I hear all the time. It is to your benefit, to your practice's benefit, to take the time to establish an inventory control process through every facet of inventory, from the selection process to the time the frames are shipped, to the time the frames are hung on the board, to the time the patient puts that frame on. We want to know where your frame is every step of the way. We want to know if every single thing we ordered is what we received. We don't want to ever be in a place where unknown frames have shown up and we just hang them on the board. We don't ever want to be in a place where we're sure we shipped frames back but don't know what reimbursement or refund to expect. We want to make sure that we're doing physical counts regularly to address shrink should it be occurring through either improper planning of the inventory or theft, as does occur periodically. Or negligence in the count, or any number of different things that can cause us to spend money on product that hasn't sold. That's something that we want to avoid desperately. The last thing we want to do is buy the same frame twice without a patient ever purchasing it. So that's the inventory control side of it. The inventory planning side is a little bit more of the long games, understanding your patient mix, understanding the demographics that your frame mix is currently addressing, and understanding where your gaps are in that respect. We want to buy, with the end in mind. A lot of opticians that I've worked with periodically will buy a frame just because it's fun, and that's perfectly okay. 1 or 2 frames isn't going to address isn't going to ruin your cost of goods. Those, you got a lot of opportunity to sell, opportunity to potentially send them back if something doesn't work out. So it's not to say that you shouldn't be at all interesting with your frame selection choices, but for the most part, you want to address the demographics that you're seeing more regularly, the brands that your patients are asking for, and one thing that I find to be incredibly important is your opticians really have to like the frames that they're looking at. As an optician, if there's one thing I know, if I don't like it, I'm not selling it. It's just how I operate. So getting your staff to buy into the frames that you're bringing in, the products that you're bringing in, is really important. And then stocking contact lenses, making sure that if you're going to have an inventory, that you buy it at a time that's most advantageous to you. And part of that is going to be developing relationships with your sales reps, and that's something we'll talk about a little bit later on. But keep that in mind as if you're going to buy a stock of contact lenses, there's a time when you know there's going to be a sale. Stock up then. If you're going to keep the inventory anyway, if you've got the space, make sure we're making intelligent buying decisions, and that's something that you're all going to do instinctively. But you wanted to make sure that it was there as part of the presentation. Now this is your inventory management options for the optical specifically, and I hear a couple of different definitions for frame board management as I consult with practices. What I mean by frame board management is number 3, order the frames as they're sold and shipped direct to the lab for manufacturing. What this allows for me is my best sellers are always on the board. I like drop shipping directly to the lab, so I don't have to worry about checking frames in, making sure that they're the right thing. I like to have them go directly to the lab, and they come to me complete. Patient gets a brand new pair of glasses. It's a winning combination of things. When I do see the reps, they're able to provide a list of every frame that I've sold and how many times, and every frame that I haven't, and then I make the exchanges from there. Other options are the traditional selling off the boards thing that most people do sort of by nature, which I think is okay, provided that we maintain a good understanding of our inventory, have ready-made understock, don't leave any gaps in the wall, that kind of thing. Number 2 here is rep-driven reorders, and I hear a lot of practices more recently than I have in the past, allowing the rep to come in, do a count, and refill slots with whatever they see are their top sellers in the area. There's something to that. Your reps nearby, and you can see, their success with it. But the issue with it is optician preference. I think we want to have the optician involved in what they're selling. Top sellers in other locations aren't necessarily going to translate here. They probably will, but not necessarily. So I actually prefer to let the optical staff take a little bit of a role in deciding what comes into the store. Those are just a couple of different ways to manage your actual inventory. Cost control, like Nathan had mentioned before, most of you on the call here are able to leverage your alliance relationship to maximize your cost savings. Like Nathan had also said, there's not a huge amount of difference between each alliance, even the big one. But you can build your vendor and sales rep relationships so that in the event that there's a sale or a promotion or something like that, and similarly with your alliance relationships, when something comes up, pay attention, open those emails. I know you get inundated with communication all the time, but periodically something's going to come along that fits right into what you want to purchase, what you were thinking about purchasing anyway. And we've got a promotion, towards the end of the year or back to school time or whenever they're run, you have an opportunity to save a little bit of money and really increase your margins there. And then the better part of cost control is optimizing your operations to eliminate your costs that are sort of self-imposed. Make sure that everything's as streamlined as it can. We don't overdo or we don't create any redundant process. Ultimately, we want to be able to control the things that we can control. So this is an operational cost control. This is the last thing we're going to cover here. As an example, frame returns. A lot of practices will bring in frames with comfortable in the knowledge that if we don't sell them, we can always send them back. So we take this example, on the left-hand side, top to bottom here, you bought 2 frames at $80 a piece. If you return them, you assume a loss of interest at 10% just for having the inventory on the board. This comes from the concept that every frame slot has value to it, and we want every frame to pay its rent while it's living there. $2.50 in shipping, various costs in labor and restocking fees. Of those 2 frames, if you didn't sell them, you're going to lose about $50 by sending them back, and it's all broken down there. If you take another tactic and just discount them at half price, and initially, you're taking a kind of a big hit to your margin, considering what your markup has been. But if you're able to sell it even at half off, you're going to gain $40 in profit rather than losing $50 and just sending it back. Simple change in the way you approach frame sales and pricing and even the whole inventory management process, but it can be a big difference to your bottom line. So there's a couple of different ideas on how to handle this. And I think that about wraps it up. Nathan, would you like to open up for questions?
Yeah, if you would, you can use the question section if you have questions, and we'll take them for a couple of minutes. And once that's done, if there's no questions, we'll let everyone go home and call it a night. All right. Well, seeing as there are no questions tonight, we will assume that we've done a wonderful job presenting these ideas in clear and understandable ways. Thank you so much for joining us. Our email addresses are here. Let me mention that if you're not a part of Select Plus or any of the consulting options with IDOC, we are available to any of the consulting levels of membership at any time to review this with you on a one-on-one basis for your practice, help you evaluate your own cost of goods and ways to improve it. So again, if you haven't, Prima members or IDOC members, consider Select Plus as well as a way to get some enhanced discounts and rebates, as well as great tracking of your metrics with the Edge and some more regular consulting with my colleague Steve here. Please look at that. And with that, we'll call it a night. So thank you so much for joining us, and we will look forward to talking to you all sometime soon.
Thanks, everybody. Have a great night.